Welcome back to Small Caps, ladies and gentlemen. My name is Kerry Stevenson. Today I am speaking with Alex Scanlon. He is the Managing Director and CEO of Barton Gold. Barton Gold ASX code is BGD. They listed about 21 months ago. I'm speaking to Alex. It's April 2023. These guys have been very busy, both pre-IPO and now that they're on the ground. They've got a couple of projects down in South Australia. It's my favourite commodity. It's gold. That's why it's called Barton Gold. Alex, great to see you again. And I really want to talk about an update. Quarterly announced was out last week. But more importantly, I think people need to understand exactly what it is that you're doing in South Australia, because I think that everyone knows WA gold, but South Australia gold, not that well understood. So let's start with, what have you been up to just most recently?
Yeah, so we put out our quarterly last week, or I should say the week before last, because we're now into the weekend. But quite recently this week, we actually put out a pretty significant resource update for our sort of main project area there in South Australia. So we have our Tarcoola and Tunkillia projects, which really function together in our mind as a single development, and that's how we're planning them. We've been really focused on laying out a very clear pathway between today and our 5-year objective. And that 5-year objective is to be a 150,000 ounce per annum producer. So that would make us South Australia's largest independent gold producer. That 5-year plan, that medium-term window, is based on large-scale base load efficient open pit mineralization at our Tunkillia project, where we then use our Tarcoola project, which is neighboring. It's essentially a satellite right next to it. We use that as the leverage to go into stage 1 operations, and we can do that because we have mining leases on that project. They were operating in 2017 and 2018, high-grade pit, and that was actually going through our mill. So we also own the only gold mill in the region. So we have the ability to sort of carefully lever our different assets together to go from pre-operations developer into stage 1 operations, get moving, generate cash flow, and then use that to grow into stage 2. So the idea is, we've been working for 5 years now on these assets to carefully build a pathway to a significant outcome with reasonable, lower risk steps that are also, less dilutionary and more value additive for our shareholders. So it's been a very big week. At Tunkillia, we've just put out a 189,000 ounce resource upgrade on that asset. So it's now 1.15 million ounces. And we've modeled that essentially. The resource itself has actually been modeled with much more of a production mentality in mind. So it's modeled on a reasonable prospects resource basis, very much like we're thinking about how we're actually designing the pit and pit scheduling. So big, broad bulk open pit mineralization, and there's a 225,000 ounce blanket that sits right on top of that in a shallow zone, and we've also mapped out a 300 meter long high grade core. So a lot has come out of this work this week, and we're pretty excited with the results.
You said a moment ago you used the term lower risk. What did you mean by that?
So I'm a nerdy economist.
I know.
In a lot of ways.
Really important. Sorry to interrupt.
As we know, yeah. Look, if we think about a conventional project development pathway, right, is you've got an idea, you do some work, to test the potential outcomes under a range of potential circumstances. But the value of anything is based on, if we think about the value today, what is the value today of anything? It is the value of a potential outcome multiplied by the probability of that outcome. So you can have a potential outcome of 100 with a 1% chance of success, and your expected value, your value today is 1. Okay. But if you have an achievable, technically sound outcome that maybe you're not, cranking the volume knob to 200, and you're aiming for an outcome of 80, but your probability of success is 30% or 40%. Well, now your expected value is, 24 or 32, right? And it's kind of a way of thinking back to front and front to back. But what we're looking at doing is essentially leveraging the platform that we have in a specific order of operations so that when we go from today into stage one operations, we won't need to spend $150 million to build a new mill. We have a mill and we can start that mill for, let's say, $5 to $10 million, right? A standard mill restart and reconditioning and recommissioning. That is a much shorter drawbridge to cross. It's much lower risk, much less capital raise. And then we get that going. And once you have that going and you're, if you put 2 to 3 gram per ton ore through our existing mill, it will produce 40 to 60,000 ounces per annum. So now you're producing, a still modest, but a good amount of gold, and you're earning profits. Now, when you go into your phase 2 expansion, where you're going into the really big bulk operations, we will build the second mill next to that operation because it's going to be big, it's going to be efficient. But you're going to do that, one, not as in the first instance, not as kind of a dreamy-eyed explorer, right? And there's nothing wrong with that because everybody's got to make that jump at some point.
Yeah.
But we have that intermediate ability to use our mill and say, okay, we're not, this is not hypothetical. We are operating. We are generating cash flow. So when we're talking to the market from an equity standpoint, we have a very different valuation proposition if we need to raise external capital, but we're also generating cash flow and profits from that mill, which we can use to fund the equity component of building our new mill. And that's also very important when you're talking to your creditors, right? If you're talking to credit financiers and you say, I have a $250 million proposition that is going to take me from producing, say, 50,000 ounces per annum to 150,000 ounces per annum. And the difference between those two things is the difference between being a $300 million company and being in today's market, which, as we know, is a very depressed market for gold equities, paradoxically. That's the difference between being a $300 million company and a $2 billion company. So it's a very important step, but you can say, look, Mr. Banker, I'm not giving you senior security, which is merely a promise and a pile of components on top of some undeveloped dirt. You have real security value in my existing mill, which is pouring gold and giving me cash flow. So, you can have a much more commercial discussion around your financial terms for credit on the development of that mill. That provides leverage to your economics for your equity holders on the front end, but it also provides you leverage in terms of your economics for your equity holders on the back end, because what happens traditionally when you go to build a mill and you're borrowing money on the promise of delivering a mill, which will then in fact become the security for a bank, you're actually borrowing money on mezzanine terms. Whether the bank is saying, we're going to lend you money at effectively 16%, or we'll lend you money at 7%, but you have to go hedge 75% of your production. When you do that, you're giving away 15, 20% of the value. So you're paying 15, 20, 25% for that. And those are actually cash flow returns coming out of the pockets of equity shareholders. That is cash flow coming out of the early years operations of that operation. So that makes it riskier, because when you squeeze your cash flow margins, you actually expose that investment, the sort of return of capital, to a much higher degree of risk. So it's carefully levering step to step to step. Now the challenge is on the one hand, as quickly as reasonably possible, moving from A to B to C to D, and at the same time being responsible and restraining yourself from trying to sort of break into a sprint before you've tied your shoelaces. Yes. So, we have we're sort of serving many masters in this, in terms of our objectives and our approach to delivering a high probability outcome. But we are, with this resource upgrade, this is the culmination of and sort of validation of many theses that we've been building up about that particular resource. It really crystallizes that 5-year forward stage 2 base of mineralization. Now we have some really clear pictures about where we can continue to grow that. And we're pretty sure we're going to find repeats of that as we continue along this year. So this year now, we also will start to swing the camera lens the other way and focus on some of the shallow, high-grade mineralization at Tarcoola, where we have a fully permitted mining lease, where we have an existing high-grade open pit that has high-grade material on the floor. we'll stack up some ounces there and we'll show people, okay, stage 2, the pathway to that is now clear enough. Stage 1, here now you can see the pathway to a restart of operations. So we bought these assets. We spent a lot of money on them privately instead of rushing them straight into an IPO. Then we did an IPO. We raised $15 million. We told you what we were going to do. We've spent 24 months now, or 21 months, validating these theses. So the proof of geological concept is there. 2023 is now about really actually crystallizing that. Now we're no longer backwards looking. We're kind of a little more in the present. We're delivering resource updates. We're laying out the pathway to additional, or sort of the next resources growth, making that clear. Because we want to come to the end of this year now. We want to do further growth at Tunkillia. We're going to add ounces and new, again, sort of ounce development pathways at Tarcoola. We want to come to the end of 2023 and say, look, we bought these things, we grew them. Then we IPO'd them, we grew them, we grew them, we grew them again. They're going to keep growing. And now we're going to start shifting our thinking forward. You know, we've got a forward-thinking view. Now we're going to start shifting our focus forward as to how we're actually going to bring these on in sequence, right? And so it's 2023, coincidentally, with the market, is a really transformative year for us, from backwards looking to forwards looking. And then what's obviously pretty exciting for us is the market seems to be swinging into position to support that message, just at the same time as we are starting to think about that sort of operations and what could this look like in terms of profitability and cash flows and, you know, true potential of these assets in operation. So it's all, you know, I'm rabbiting on, but we're pretty excited. This has been a lot of work to get to this point, and the team has done an exceptional job. So
you just mentioned the word sequence, and as I said at the start of this conversation, we're talking in April 23. Paint a picture, if you like, of the sequence for 2023. What are the steps? Because what I want our audience to understand is, I guess, the value milestones for shareholders or potential shareholders.
Yeah. So a big one, you know, this week, I think the takeaway from the update this week is we've kind of like set the anchor with the Tunkillia asset. Okay, it's not. This is the second time we've grown that asset since we bought it. When we bought it, it was 558,000 ounces. In 2020, before we IPO'd, we grew it to 965,000 ounces, and now it's 1.15. So we've kind of crystallized now twice, 2 resource upgrades, 2 growths. We've set that on a path, and I think that's a really important thing. You know, we've put critical mass on that. It's gone over 1 million ounces, which is an important, you know, sort of psychological milestone. Both in terms of, you know, I guess, you know, potential value and the developmental scale. So that is sort of like crystallizing the medium term. And now we're going to start building backwards. We're going to keep growing that so people can see that the future scale is growing. But now we start building backwards as well. And we're going to start filling in the distance between now and that 5-year target. And so when we come to the end of this year, we want to have both additional resource upgrades for Tunkillia, but also Tarcoola. So people can say, okay, if the 5-year plan is to be producing 150,000 ounces with Tarcoola and Tunkillia operating in tandem together, maybe the 2-year plan is to be producing 50,000 ounces. Right. Now, where do those ounces come from? Well, you have an existing pit. So we put some ounces on that pit. We actually crystallized resource on that pit. So the drilling we've done around that, we haven't yet put into JORC resource. So we do some additional work. We turn that into JORC resource. And we will go and test 5 or 6 of our favorite targets for repeats of that style of mineralization, both on the mining lease and immediately next to it, because we've lined up now, we built a structural model very carefully over the past 2-3 years, where we think we've identified the potential to have a cluster of these high-grade pits. And so to put this in context, you know, because we have a mill, we don't need to think about the traditional development model is I have to pre-strip, and I have to get into operations, and I have to figure out how to pay back the construction of a mill in and amongst all this, which I've already laid out $150 million for, right? So we've got to remember, in capital investment, you are negative carry, right? You are deep in the hole before you even turn on your first hopeful dollar of revenue. We don't have to worry about paying back a mill. So it is a case of, for us, it's not, you know, we don't have some minimum threshold that of grade that will make this successful. We just need to find our favorite 600,000 tons to put through that mill every year. So every 600,000 tons that we put in, I guess, future reserve, but say every million tons of resource, if we can convert 60% of that to reserve, that's a year of stage 1 mineralization, right? And so we can start locking in blocks of resource that we can say that is, we might call that JORC resource because we haven't done a feasibility study around it. We aren't calling it a reserve yet, but on that existing open pit that we have, that is a zero pre-strip, zero pre-capex, walk up and restart operations, fully permitted mining lease. So ounces on that pit are extremely economic ounces, and that starts to really crystallize in people's minds and crystallize the pathway forward to, all right, now we've got 1, 2, 3 years of stage 1 material. We're really comfortable, stepping on the gas and accelerating the restart of that mill. And then you get that mill going and you get just nice, steady operations going. And if you've got 3 years of runway, then you've got a team that's focused exclusively on running that mill. We'll bring in a third-party contract to run the pit. There's some very, very good operators in the region, including one who was operating that pit very well in 2017 and 2018. And then you keep the team focused on extending the medium-term big picture scale and getting that permitted so that you can then 3 years later shift from 50 to 150,000 ounces, which is that quantum leap. If we go from today to 50,000 ounces and we say, let's assume, let's guess, hypothesize that we're making, at today's gold prices, $1,500 an ounce from a high grade open pit, right?
Yeah.
50,000 ounces per annum. You're talking about $75 million in gross free cash flow. Now choose a multiple and let's choose a really conservative one and say, six times gross cash flow valuation. That's $300, $400, $500 million, right? But when you look at the valuation for any operation is nonlinear as it relates to scale. Shifting from 50 to 150,000 ounces per annum, where you're then going, you're not only increasing your productivity, but you're decreasing your cost per unit. If we're then producing 150,000 ounces, for $1,300 or $1,400, you're talking now about producing, $220 to $250 million in gross free cash. And on any, multiples tend to expand as you go with scale, and you've got a larger productive base. That is the difference. You might triple your production, but you might quadruple or quintuple your valuation. So you really want that team focused on that, which is why, you're asking the question about sequencing, you sequence this carefully so you can execute it cleanly, because the payoff from A to B and B to C is very, very high. And if you can minimize the cost and risk of getting from A to B to B to C, that is how you optimize that return to risk component. It's how you increase the probability of execution, and that's how you increase the actual value today.
And that's why it's important to have a financial economist running the business just quietly. Now, Alex, is there interest coming in from overseas as well as people begin to understand this? By the way, we're running out of time, so we're going to have to shorten it up and just let me know, what's the interest like at the moment?
Yeah, look, it has been I wouldn't say it's a surprise. It's been pleasing. So we focused actually on getting out now and speaking more with European and North American investors. It's really the first time we've been able to do that because we're out of the COVID bubble.
Yep.
And so that has been, we've actually had a very strong return in our shares since November. Actually, the 1st of November, we kicked that off, and I think we're up, went from 14 cents to 23 cents in that time. So we've had a very strong feedback particularly from, more sophisticated investors who think in terms of long-term macroeconomic cycles. They definitely like gold. The feedback we're getting is, we feel the wind's changing. We're looking for who we're going to back for the next big cycle. And we respect the value of the quality team and what you guys are doing, not only to advance these assets, but defend shareholders from otherwise necessary dilution. So you are one of the teams that we want to back. So we're the work that we're doing and the shifting sentiment is coming together very nicely for us. Yeah.
Okay. Before I wrap it up, any challenges that you see on this roadmap going forward?
There are endless challenges, right? I mean, running a business like this is based in, real assets in the dirt, in the outback. You sometimes have to deal with extreme rains. You have to deal with unpredictable people who hold the keys to things like, permitting and approvals. That's why it's so essential that, our mining leases are fully permitted. We have full environmental licenses and everything. We have our EPA license to run our mill. So the ability for us to step from A to B at our discretion without needing someone else's approval is literally priceless. That's 2 to 3 years of approvals we don't have to get.
Yeah.
And it's somebody else's discretion that we don't necessarily need, right? So that's important. But when we think about, challenges, the number one challenge is metal price, right? It's market sentiment. And we have this huge bifurcation between metal price and market sentiment right now. I think, thankfully, that seems to be swinging back into line. And I do think that people are coming back into gold. And I have people recounting to me that these, sort of very excited, lithium investors and rare earth investors and Bitcoin investors who are now coming to them and saying, hey, have you heard about gold? So the focus is coming back. And, I do think we're on the better end of the bet there in terms of the key tailwind, which is market support. Because if we continue to get market support behind the type of performance we are regularly delivering, we have the best chance possible with our team. We have an excellent team, the best chance possible of delivering this sort of roadmap to success that we've laid out.
All right. Well, Alex Scanlon, I want to wrap it up now and just ask you for, I guess, 3 reasons. People know I ask this all the time. 3 reasons why you think they should be sitting up and taking notice of Barton Gold right now.
Yeah. Look, the first thing, this is always the first basis for investment for me when I was managing money privately, is the people, right? We have 200 years or more of experience just in our board and senior team, exploring for, discovering, permitting, financing, developing, and operating assets. We have a very, very rich pedigree, both in South Australia and Australian gold. 3 of my senior team members were former senior members of Normandy Mining, which was Australia's largest gold producer, right? So the people are key. The platform on which we are operating is essential. We have some extraordinary advantages in the market. And then the performance, right? We like clockwork. Every single month, you can look at our announcements. Every single month, we're putting out a real material announcement. It's not 6 months of fluff and then drill results. Every month, we are relentlessly driving forward towards our objectives. We have done that like clockwork. We've done it faster, better, and cheaper than we thought we could even do it, better than we promised. We're going to keep doing that. So, we have as good a reason as anyone, because we are also, the board and management are 32.9% shareholders in this company. We are you and you are us. So if you want to bet on somebody looking out for your best interests, pretty good bet we're in the same boat as you.
What a great way to finish it up. Alex Scanlon, Managing Director and CEO, Barton Gold, ASX code is BGD, as I said before. Congratulations on all the hard work. It's beginning to pay off, that resource upgrade, and that the way you've taken it from 550 to over 1 million ounces is impressive. But also, ladies and gentlemen, I think it's important to understand that where they're located in the Gawler Craton, lots of infrastructure around. It's not a stranded asset. And so this will be taken into development and finally into a mine at some point in time. But Alex, great to see you.
Thanks.